Hi, we'd like to welcome you today to our taxable income from Parking Fringe Benefits and what does this mean for your business webinar. My name is Matt Latham. I'm a senior tax manager here at Manor, and with me today is Brandy Twilliger.
Good morning. I am a tax partner here at Manor also.
So let's get started. Today's agenda, we're going to take a look at exactly what changed in the code, the definition of what a qualified transportation cost is. We're also going to take a look at what does parking costs include. We're going to look at how does section 132 apply. Also, we're going to look at the impact for not-for-profit organizations in addition to for-profit organizations. We'll go through some exceptions, the steps to actually calculate the taxable portion. We'll take a look at some in-depth examples and then wrap up with some takeaways and planning opportunities as well. So this came into play with the Tax Cuts and Jobs Act that was passed towards the end of 2017 and basically is effective for amounts paid or incurred after December 31st, 2017. So this will apply to a calendar 2018 taxpayer as well as a fiscal year ending 2018 taxpayer, at least in part for them. Basically, Section 274 generally disallows a deduction for expenses with respect to qualified transportation fringes or QTFs that are provided by the taxpayers to their employees. And Section 512 generally provides that a tax-exempt organization will have some impact to their unrelated business tax income, as it will increase the amount of UBTI by the amount of QTF expenses that is non-deductible under 274. So what is a qualified transportation fringe? Qualified parking is provided to an employee by an employer on or near the employer's business premises or at a location from which the employee commutes to work other than property used by the employee for residential purposes and may be provided on property that the employer owns or leases. So if you by chance have a home business that you just work out of your house and your business is actually located at your house, you're not going to have to worry about going through and doing any kind of special calculation by trying to figure out how much your parking value is outside your home. So there's a little bit of relief and you can exhale on that. It's also transportation in a commuter highway vehicle between your residence and place of employment, and also includes any transit pass. What is included in parking costs? Third-party payments to parking facilities, lots, garages, and similar parking facilities. It also includes, and know this is going to probably catch a lot of people off guard, any repairs, maintenance, utility costs, insurance, property taxes, and all the other expenses that you see there, generally the cost of maintaining the lot. The good news is it does not include the depreciation that you might take on your parking lot, so we at least got a little bit of break there. It does include the rent that you pay as well for the parking lot or structure, and if your actual lease or rental agreement with the building that you're renting out of doesn't include any type of breakout for these lease payments, you are actually supposed to go through and calculate a portion of those lease payments and allocate them to the actual parking lot, which we'll go through or discuss. So 132A5. Section 132 generally provides that gross income does not include any fringe benefit that is qualified as a QTF. So while the business doesn't get the deduction, on the flip side, the employees don't have to pick up income on your 1040 if you by chance get reimbursed for any parking costs that you pay. There is a little bit of an exception to that. Section 132 provides that the amount of QTFs cannot exceed a maximum monthly dollar amount, and it is adjusted for inflation. This maximum dollar amount for 2018 was $260. For 2019, they increased it a whopping $5 to $265. An employer may provide QTFs as a supplement to an employee's compensation, either in kind or through some sort of cash reimbursement arrangement or a compensation reduction agreement. However, Section 274A4 still disallows a deduction for the expenses incurred for QTFs regardless of how the benefit is provided. So they basically are trying to look and capture any loopholes that might exist. So the interesting thing about this topic is that although it's kind of a very specific topic, but being here in Lansing, obviously there's a lot of taxpayers that work downtown that potentially are concerned about this, as well as obviously any other major city that might have parking expenses. But the unique thing about this is this actually does have a broad reach between both for-profit and nonprofit entities. On the for-profit side, a couple things just to consider, even though the general rules kind of apply, I think, to both types of organizations. For-profit, just some things to consider is that partners greater than 2% shareholders, S-corps, sole proprietors, or independent contractors, basically people that are considered self-employed individuals, are not considered employees for this section, which does mean that any parking costs that these individuals incur as a business expense is non-deductible to the business. But again, I guess on the flip side is that the benefit is that you don't have to include it in compensation. So next, Brandy's going to talk about some of the nonprofit concerns.
Thanks, Matt. First, I'm going to talk about just how this affects the not-for-profit organizations. So apparently Congress thought it would be a neat idea to put not-for-profits kind of on the same playing field as a for-profit company when it comes to disallowing this deduction. It seems a little bit crazy since we're not the same type of organization. There's a reason why we're not-for-profit, but unfortunately it's how it came out. So with that, tax-exempt orgs must increase their unrelated business taxable income by any amount for which a deduction is not allowed under Section 274 for any qualified transportation fringe benefit. So this does not apply to the extent that the amount is paid or incurred is directly connected to another UBI trade or business. This is when some of our organizations might already have unrelated business income regarding their parking lot if they're renting their parking lot out on weekends or something for sporting events or something similar to that. So this would be the expenses that aren't related to that other trade or business. It's also not considered its own trade or business. So there's actually a separate line item on the new 990T for this fringe benefit amount. So there's no allowance to be able to deduct any costs from it or anything to that extent. The only good thing about it is if you're not filing a 990T at this point, you have no unrelated business income, and you determine that your parking costs, based on what we talk about later and how to calculate it, is under that $1,000 specific deduction, then you don't have to file a 990T and pay tax on that portion. So that's kind of a nice thing that we do get for the not-for-profit area. So under Section 274A, there's 9 exceptions to different types of deductions that you might get, but there's 2 that are relating to the parking. And Matt talked about it earlier, so I won't go into a lot of detail, but there's an exception that if the value of the qualified transportation fringe benefit exceeds that 132 limitation, which is $260 per employee per month for 2018, and then it goes up to $265. It does say, hey, if you end up going, those costs per month per employee is over $260, that part that's in excess of that, that's compensation to the employee, and therefore you do get a deduction for that as compensation. I don't see this happening too much in Michigan, maybe down in the Detroit area, just because it doesn't seem like parking costs would exceed that amount. But if you have a location where it does, then that's an option there. There's also the general public exception, and we'll talk about this in the steps that I'm going to go through in a minute. And this is saying if you, in the second step to the calculation, if you have determined that over 50% of your parking lot, after looking at your reserved spots, are used for the general public, and that would be visitors, clients, people like that, then the nice thing is at that point in the calculation, you can skip the rest of the steps and you don't need to have any more non-deductible costs. So an example would be, for me, I think would be like a museum. And if you only have maybe 8 employees working or something like that, none of the spots are reserved, but the rest of the parking lot is really for general public, for your visitors, then you may get out of this having to calculate this loss of deduction. So we're going to talk about the steps to calculate. A lot of this information, along with the examples that we're going to talk about, all come directly from the notice that was sent out from the IRS. And I just want to also state that that notice was interim guidance, so we still don't have proposed regs, but this is what we can rely on until we get more information. And just a reminder before the calculation of this, if you pay a third party for employee spots, the disallowance is generally calculated as the total annual cost paid to that third party, unless you have over that 132 limit of the 260. So when we're talking about these steps to calculate, this is usually if you own or lease a parking lot facility. So first step is to figure out your reserved employee spots. So an organization that owns or leases all or a portion of a parking facility must identify the number of spots that are exclusively reserved for employees. So these could be spots with a sign that says employee only, or a separate facility, a little separate garage that's just for certain employees, or a gated area for employee only. You determine the number of reserved spots in relation to your total parking spots, and then multiply that by the percentage by your total parking costs. The product of this calculation is the amount of the deduction for parking expenses that is disallowed under Section 274 for reserved employee spots. Taxpayers do have until March 31st of 2019 to change their parking arrangements to reduce or eliminate their reserved spots, and that this change would be retroactive to January 1, 2018. So in that museum example I gave earlier, if they did have 8 employee signs that say employee only, they could potentially have some non-deductible or UBI costs for those spots. So I always say, well, just take down the signs and put a cone. But I don't know, there's probably some creative ways to get around that. We've also laughed and said, could we have one that says IRS agent only, and then they have to pay tax on their spot? So just some thoughts on that. So that's step 1. So once you first determine if you have any reserved employee spots. Next, you're going to determine the primary use of your remaining spots. So the taxpayer will identify the primary use of the remaining spots in the parking facility. If more than 50% of the remaining spots are used primarily for the general public, so not employee use, then there is no more non-deductible piece, and you can stop the calculation here. When they determine primary use, they're determining that during normal business hours on a typical business day. If that usage varies, the taxpayer may use any reasonable method to determine the use. And like I said earlier, the general public includes but not limited to visitors, customers, clients, patients, students, and congregants. And we'll go through some examples that show how to do this. So that's step 2. So hopefully it's general use and you don't have to worry about it. But if you do determine that over 50% of your remaining spots are for employee use, you have to continue on with the calculation. So step 3, you calculate your reserved non-employee spots. So if you've determined that your primary use is for employee use, then you will identify the number of spots reserved for non-employees, if any. Just like the calculation step 1, you'll determine the percentage of reserved non-employee spots in relation to the remaining spots multiplied by your parking costs. These are non-employees are visitors, customers, as well as spots reserved for partners, sole proprietors, and 2% shareholders of S-corps. And this is typically reserved by signage or a separate facility. An example would be a customer parking only spot or visitors only or something like that. So if you have none of these types of spots, then you skip to step 4. Step 4 is you're going to look at the remaining use of the parking lot and allocable expenses. So if after completing steps 1 through 3, there are remaining parking expenses that are not specifically categorized as deductible or includable or excludable in unrelated business taxable income. The organization must reasonably determine the employee use of the remaining spots during normal hours on a typical day for that organization. Actual or estimated usage may be based on number of spots, the number of employees, or the hours of use or other measures. The notice kind of just implies that any reasonable method at this point they'll accept until we get more guidance.
So now we have quite a few examples here. We'll take a little bit of time and go through each of them just so you get some idea of how the calculation is supposed to work. I know how exciting math can be on these webinars, so we'll try to get through it as quickly as possible, but we do think it's important that you kind of see the mechanics behind it a little bit, especially if as you're producing support and work papers for this, that you're able to kind of identify and take out every cost that you need to pull out to try to make things easier to calculate the limitations. So the first example, and some of these examples kind of build on one another too. The first example is a pretty straightforward example, is that taxpayer A pays a third party who owns a parking garage across the street from A's place of business. They get charged $100 a month for each of A's employees to park in the garage. This comes out to $12,000 per year, so you have the $100 times 10 employees times 12 months to get $12,000. $100 per month paid to each employee for the parking, therefore is excludable under 132, and in this case we don't have any exceptions that apply, therefore the entire $12,000 is disallowed. In the second example, we assume the same facts as the first example, except in this case A pays $300 per month for each employee, or $36,000 per year. Of the $300 paid for the parking, we're obviously over the $260 limit here, so $260 is going to be excludable under 132 and the 274 disallowance. In this case, none of the exceptions apply, therefore $31,200, or you take the $260 limit times 10 employees times 12 months to get to the $31,200, is subject to the disallowance. The additional amount, the additional $40, is not excludable under 132 and is actually treated as compensation and wages. As a result, in this case, the 274 exception applies to this amount because we're over the $260. Therefore, $4,800, or you take the total cost, $36,000, less the disallowed cost of $31,200, remains deductible. In the next example, where in a case where you own or lease a lot or garage, taxpayer C is a big box retailer. They own a surface parking lot adjacent to its store. C incurs $10,000 in total parking expenses. In this case, C's parking lot has 500 spots that are used for customers and employees. C usually has about 50 employees parking in the lot in non-reserved spots, so it's just general parking, during normal business hours on a typical business day. C has approximately 300 non-reserved parking spots that are empty during normal business hours on a typical business day. Because none of C's parking spots are exclusively reserved for employees, there's no amount specifically allocated to reserved employee spots. That's the first step. In the second step, you're looking at the primary use. The primary use of the lot is to provide general parking because 90%, or 450 of the 500 spots, is used by the public. The 300 empty non-reserved parking spots are treated as provided to the general public. Thus, expenses allocated to these spots are exempted from the 274 disallowance. Again, because the primary use of this parking lot is to provide parking for the general public. Therefore, none of the $10,000 is subject to disallowance. You don't need to do any further steps. I do believe this is also the case. I know in some retailer businesses or in some businesses it does provide general parking. Sometimes they'll tell employees, try to park in the back so the public so your customers can park near the front door. At least I believe, in our opinion, that doesn't mean that those spots are specifically reserved for employees because you don't have a sign out there. Technically speaking, your employee can park anywhere, and technically speaking, the general public can park anywhere. So you don't necessarily have to worry about if you tell employees, they need to park in certain spaces, but you don't actually have a sign up. That still allows you to consider that the lot is for the general public, since technically they can park anywhere.
So I'm going to talk about a situation in which a manufacturer owns a surface parking lot adjacent to its plant. This manufacturer incurs $10,000 of total parking expenses. The parking lot has 500 spots that are used by its visitors and employees. The manufacturer usually has approximately 400 employees parking in the lot in non-reserved spots during normal business hours on a typical business day. Additionally, the manufacturer has 25 spots reserved for non-employee visitors. So if you just run down the calculation, step 1, none of these parking spots are exclusively reserved for employees, so there's no amount to be specifically allocated to reserved employee spots. Step 2, the primary use of D's parking lot is not to provide parking to the general public, because 80%, 400 employees over the 500 total spots of the lot is used for its employees. Thus, expenses allocable to those spots are not accepted from the disallowance under the primary use test. Step 3, 5%, so 25 spots over the 500 of D's parking lot spots are reserved non-employee spots. So up to 9,500, so you're going to, the 10,000 times 95%, which is 9,500 of D's total parking expenses are subject to the disallowance. So 5% they don't have to worry about. So then D must reasonably determine the employee use of the remaining parking spots during normal business hours on a typical day and the expenses allocable to those parking spots. So in this case, it's a little bit confusing, but so at the end of the day, I would say 400 over 500, so 80% is going to be non-deductible, so 8,000.
Mm-hmm.
And that would be what you calculate in step 4. Example 5, taxpayer G, an accounting firm, leases a parking lot adjacent to its office building. G incurs $10,000 of total parking expenses related to lease payments. G's leased parking lot has 100 spots that are used by its clients and employees. G usually has approximately 60 employees parking in the leased parking lot in non-reserved spots during the day. Step 1, because none of G's leased parking spots are exclusively reserved for employees, there's no amount to be allocated. Step 2, the primary use of G's leased parking lot is not to provide parking to the general public, because 60%, 60 spots over 100, of the lot is used for its employees. Thus, expenses allocable to those spots are not accepted from the disallowance under the primary use test. Step 3, because none of the leased parking lot spots are reserved non-employee spots, there's no amount to be allocated to this. So in step 4, G must reasonably determine the use of the parking spots and the related expenses allocable to employee parking. Because 60% of G's spots, as noted in step 2, are used by G's employees, G reasonably determines that 6,000, 10,000 times 60%, 6,000 of G's total parking expense is subject to the disallowance.
Next, this example we have gets a little complex, because if you have multiple offices, or in this case, if you have just simply multiple locations, so you have multiple parking lots, you are potentially allowed to aggregate your parking, situation, I would call it, to figure out some of these steps, and it's done on a city-by-city basis. So you can't combine, say you have a location in Lansing, one in Detroit, and one in Washington, you can't combine all three, but you could, if you have, say, 3 locations within the city of Detroit, aggregate those 3 locations as one and determine some of these steps. So in this 6th example, we have taxpayer H, a large manufacturer that owns multiple parking lots and garages adjacent to its manufacturing plant, warehouse, and office building at his complex in the city of X. H owns parking lots and garages in other cities as well. For purposes of applying this methodology in this notice, H chooses to aggregate parking spots in lots and garages at its complex in city X. However, they may not aggregate the spots in parking lots and garages in the other cities with its parking in city X. H incurs $50,000 of total parking expenses related to the parking lots at his complex in city X. H parking lots and garages at his complex in city X has 10,000 spaces in total that are used by its visitors and employees. H has 500 specifically reserved for management and has approximately 8,000 employees parking in his garages and lots in non-reserved spots in city X. The first step, again, we look at the amount that are specifically reserved. In this case, 500 are reserved for management. Therefore, you take 500 divided by 10,000 for its total amount of spaces times 50,000, which was total cost, to come up with that $2,500 is automatically pulled out as amounts that are non-deductible since they are reserved for specifically employees, in this case, the management. Step 2, then, you take a look at the primary use of the leased parking. In this case, is not considered to provide parking for the general public because 8,000 spaces are used by employees, even though they're not specifically reserved by employees. So that's 8,000 divided by the remaining 9,500 spaces is 84%. Therefore, greater than 50% are used by its employees. Thus, expenses allocable to these spots are not exempt, are part of the exceptions from disallowance under the primary use test. In step 3, because none of the H employee spots are reserved non-employee spots, there is no amount specifically allocated to reserved non-employee spots. Step 4, H must reasonably determine the use of parking spots and related expenses allocable to employee parking. Because 84% of the spots that we calculated in step 2 are used by the employees, they're going to take that percentage to multiply by the remaining costs. In this case, it's 50,000 less the 2,500 that we already took out of step 1. Multiplied by 84%, that's $39,900, therefore is subject to the disallowance. So in this case, you'd have $39,900 plus the $2,500 considered non-deductible for parking for this business. You can see how these examples can get pretty convoluted in a hurry.
I was going to mention on that one too, in some cases, aggregating your lots in a specific city might actually help you get over that, or get over that 50% of general public use. So it may be beneficial to look at that to see if maybe you can get out of calculating it by having the general use for the public. So in this example, similar example to the others, but we're going to talk a little bit on the not-for-profit side. So if you're a tax-exempt organization and you operate a church and a school and you own a surface lot adjacent to your building, you incur $10,000 of total parking expenses. The parking lot has 500 spots that are used by its congregants, students, visitors, and employees, and 10 spots that are reserved for certain employees. During the normal hours of J, the church's activities on weekdays, J usually approximately has 50 employees parking in the lot in non-reserved spots and approximately 440 non-reserved spots that are empty. During the normal hours of J's activities on the weekends, J usually approximately 400 congregants parking in the lot in non-reserved spots and 20 employees in non-reserved spots. So step 1, the church has 10 reserved spots for certain employees. So that calculates, I'm not going to go through the calculation, to $200 of total parking expenses that is non-deductible for reserved employees. Thus, under Section 512A7, the church must increase its unrelated business taxable income by $200. Step 2, because usage of the spots varies significantly between days of the week, J uses a reasonable method to determine that the primary use of the remainder of J's parking lot is to provide parking to the general public. Because 90%, 440 over 490, the 500 minus the 10 reserved spots, is 90% of the spots are used by the public on the weekends. The empty, non-reserved spots are treated as provided to the general public. Thus, expenses allocable to these spots are accepted from the disallowance under the primary use test. If the church does not have any gross income from any other unrelated trade or business of $800 or more, included in computing its unrelated business income tax, to reach that $1,000 filing threshold, J is not required to file a Form 990T for that year. So on a flip side, if a not-for-profit were to have $2,000 that they've calculated as taxable income from this loss of deduction, then they would have $1,000 of unrelated business income tax after they've taken the $1,000 specific deduction. And they may have to file a 990T for the first time. Some things to consider. There was some talk last year about adding the cost of parking, especially parking paid to a third party, to employee wages, assuming that at that point it's compensation and deductible, but obviously that isn't the case anymore, and it's only for that amount that's over the Section 132 limit of the $260 per employee per month. Some thoughts, some options would be that you could have employees reimburse the employer. Like if it's easier for the employer to pay the lot or the parking ramp in one lump sum, you could have your employees then reimburse the company for their portion of the parking. Another option some people have said is, if you don't want it to reduce morale, you could give everybody a raise and then have them pay their third party directly and pay for their parking that way. But they're actually paying it, but they would have to do that directly to the parking structure. Some questions on lease space. This has been kind of an up in the air question. If you're leasing a specific lot for the benefit of your employees, your lease payment is your parking costs and any other costs that you maybe have to incur to maintain it. But we've talked a lot about if you lease a building and then you get incidental parking. So you're not the only tenant in that building, or maybe you are the only tenant in that building. And in most cases, you lease the building to get the building space and you just get the parking. It's not separated out in your lease. We don't know specific answers, but we are taking a position that at this case, you don't really have parking costs. You have a lease expense. And so in that example, in that situation, we don't believe that you would actually have parking costs. Another question that came up that we're still hoping to get some guidance on is if you have a large company and maybe all of your maintenance, all of your snow removal, all of your parking maintenance is done by an internal maintenance department. So you don't hire anybody, you don't hire a snow plow company, you don't do any of that. How would you allocate those parking costs? Would you allocate a portion of your maintenance department's wages to the time spent on parking lot? It could just get really kind of silly if you ask me, but we're still trying to wait and see if we get some further guidance on things like that. Prior to the government shutdown, I had heard from our friends at BDO that maybe there would be a repeal for the not-for-profit part of this law, but then we haven't really heard anything since because everybody's furloughed and no one's answering their phones.
They have other issues right now.
Yeah, they have other issues to worry about. So still kind of hopeful, but we definitely should plan for this, especially if those parking costs are going to be a large amount for the companies, so we can plan ahead. But we're still kind of hopeful, I guess, on the not-for-profit side.
I did kind of want to add, specifically thinking about situations where if you're a tenant in a building or in a mall, I guess, where you might have specific spots allocated to your business, but it's not necessarily to your employees. It's just these spots are specifically, I mean, we've seen them everywhere where you go to an area, or if you go to a mall, or you just go to like an office park and you say spots reserved for ABC company. I would say that in that situation, since it's not specifically for your employees, that anybody from the general public could park there. That again, you don't necessarily have to. You're gonna get over that 50% exception pretty quickly. So it's something that I don't think you necessarily have to be too concerned about. If you're sitting there thinking, well, I have all these spaces that are reserved for my business, does that count? What do I have to do? So even in potentially in a situation where you have a couple of employees parking, in those spaces, assuming that you still have enough other spaces that are reserved, you're going to get over that 50% primary use exception. And the other issue that I see on the audit side is that it always takes a couple of years before audits start to occur before the law actually goes, or after the law actually goes into effect. So, we have had this law in effect already for a full year. We're just now, and well, in some cases with fiscal year filers, there have already been some returns filed with this issue out there. For calendar year filers, you're just now going to start filing those returns, and it might take a year or two for the IRS to actually start to audit these returns. So now we're talking 2021 before audits start to occur, maybe 2020, and then you're going to really see where the IRS is coming down with their positions, since I know sometimes they do like to use audits or court cases to actually either strengthen or weaken tax law if they can, depending on what the situation actually is. So basically, this is just a long way of saying that it could take some time before things are absolutely crystal clear. It's just going to be important to document things as much as possible. Again, you've heard the phrase reasonable allocation or reasonable method quite a bit. If you can defend your position, as long as it's considered reasonable, and yes, what we or what you might consider reasonable versus what the IRS considers reasonable could be drastically different, but at a minimum, just document everything. The more documentation, usually the better. And the other thing is take a look at rearranging spaces, signs, things like that. Like Brandy said earlier, by the end of March of this year, don't wait, because then at that point, if you start to play around, then that's obviously not going to look good. Should a tax return get selected for an audit, and then an agent discovers or figures out that you've been kind of playing this game after the March 31st deadline, that kind of gets them on edge a little bit. So take advantage of the time you have now to take a look at how things are set up outside, even though it's like 5 below outside right now. The last thing that we wanted to talk about is that there is some penalty relief specifically being provided for estimated tax penalties for 2018. One's for tax-exempt organizations that did not pay estimated income tax in connection with their UBTI, reportable under 512A7. This relief is only available to organizations that were not required to file 990T for the previous tax year. So basically, they're just trying to help out in cases where organizations weren't necessarily planning on potentially having to file a 990T this year. And so that at least is a little bit helpful. The last notice, which was actually just released or last week, is that it's notice 2019-11 that provides relief from estimated tax penalties for certain individuals who would be required to make 2018 payments before the January 15th payment was due, which would have been your fourth quarter payment. The waiver is limited to individuals whose total withholding and estimated tax payments at least equal 85%. So to give you a little bit of relief, basically, and this is actually not just specifically for this particular piece of the tax law, it's for the new tax law in general. They're kind of giving you a bigger cushion should you be too low on your estimated payments. As long as you got 85% of your 2018 tax covered, then you're going to get penalty waivers, or you're not going to get penalized for being underpaid, which at least is, and this is also only for federal. Obviously, state is a totally different issue, and we know how much state loves to collect money, since they always say they don't have any. In case you're curious and you want some good reading, or you'd like to cure if you're having trouble sleeping, there are these two notices, and I guess that third notice, since it just came out, the 2019-11, that were used for this presentation if you want to take a look at everything that the IRS came out with. We have our contact information there. We're always available for questions. Should you have any after this webinar?
Yeah, I would think it would just take a few minutes to sit down and kind of look at your current parking situation. In a lot of cases, you may be able to get out of it if you can somehow get under that public use exception. But just look at your situation, and if it gets to be a little bit complex, feel free to contact your whoever your contact is here at Manor or Matt or I.
I'd like to thank you for joining us for our webinar today. So we appreciate the time that you've taken to join us. And like we said, if you have any other questions, just do not hesitate to reach out. Thank you.